Let me ask you a question. Have you ever entered a trade thinking you're catching the perfect dip, only to watch price go nowhere or even reverse and hit your stop loss? That's not just bad luck. It's the consequence of misunderstanding the difference between a retracement and a consolidation. Most traders lose not because their direction is wrong, but because their timing is off. In this video, I'll give you a clear psychological and visual breakdown that separates amateurs from professionals. Let's dive deep. A retracement is a temporary pullback in price within a dominant trend, not a trend reversal. Imagine a strong trend moving in one direction. At some point, traders take profits, liquidity rebalances, and price pulls back, but only briefly. That move is a retracement. In the chart shown, we have a clean downtrend. When price retraces upward, it doesn't break previous highs. Instead, it stalls and resumes downward. This moment offers professional traders a second chance to enter the trend at a better price. Retracements are healthy pauses in market structure, not a signal to panic. Consolidation is a phase where the price moves sideways, usually within clearly defined support and resistance boundaries. Unlike retracement, there's no trending movement, just indecision. This often follows a strong price move when both buyers and sellers pause to reassess. On the chart, we see price bouncing in a tight range. Traders call this a range-bound market. Volume tends to drop and volatility compresses. This phase can be frustrating, but it builds potential energy for an explosive breakout in either direction. This chart illustrates the real battle behind the candles, the psychology of price. In a retracement, one side temporarily pulls back, but the trend remains dominant. In consolidation, both sides are equally weak, stuck in a tug of war. Notice how in an uptrend, retracements become smaller, signaling the sellers are giving up. In a downtrend, if bullish pullbacks grow weaker, buyers are exhausted. But in true consolidation, no one is winning. This information is gold because the smaller the range, the bigger the breakout. Here's the secret most retail traders ignore. Don't trade inside consolidation, trade the breakout. Look at the USD CAD chart. You'll see wedge formations, flags, and horizontal channels. What do they all have in common? They're all traps. Price chops sideways, then explodes. But the explosion only works for those who wait. The pros? They wait for a strong breakout candle, backed by volume, and only then enter. The amateurs? They guess early and get stopped out. Be the sniper, not the scattergun. Retracements often respect powerful tools like Fibonacci. These levels, especially 38.2%, 50%, and 61.8%, are not random. They are psychological magnets where price reacts, pauses, or reverses. Look at this chart. After a strong rally, price pulled back right into the 50% level, the golden zone, before bouncing again. Why? Because that's where institutions wait. If you align Fibonacci with market structure and candle confirmation, you've got a high probability entry. Don't just trade pullbacks blindly, trade them strategically. Let's go deeper. Consolidation zones are where smart money operates. These aren't random sideways movements. These are liquidity traps. Retail traders get excited, buying every breakout and shorting every breakdown. But the pros, they accumulate. They build massive positions quietly. Look at this structure. Price compresses, fakes a move, and then reverses explosively. That's institutional fingerprinting. Want to trade like the big players? Learn to wait during the trap phase and strike on the breakout with confirmation. This chart is painful because it's exactly where most retail traders lose money. Price pulls back slightly, looks like a retracement, and traders rush in, thinking they caught the bottom. But guess what? That was a setup. Institutions use these mini pullbacks to create fake support zones, lure in longs, and then slam price down. In this example, 150 pips vanished after the fake retracement. If you don't confirm with structure, like a higher low bullish engulfing or trendline break. You're just fuel for the next move. Every trend follows a cycle: impulse, retracement, continuation. This isn't theory, it's market rhythm. The image shows each pullback happening within key support zones. These zones are like the market's heartbeat. When they're respected, it means trend strength is intact. But when they're broken, danger is near. Use trend lines, previous highs or lows, and Fibonacci together to mark retracement zones. These aren't random. They are high-value decision points where the smart money takes action. Here's the complete blueprint, the three-phase model of price: consolidation, expansion, retracement. First, smart money consolidates, accumulating silently. Then comes expansion. Price breaks out fast, fueled by momentum. Finally, retracement, the cooling off, the reset. This chart shows it beautifully. Consolidation builds the base. Expansion breaks the cage. Retracement offers re-entry. If you know which phase you're in, your trades won't just be good, they'll be precision engineered. Here's what separates amateurs from pros. Read the chart story. They don't guess. They don't chase. They wait for context. Retracement and consolidation may look similar, but their meanings and outcomes are worlds apart. One is a tactical pause in the trend. The other is a psychological battlefield. Master them, and you master timing. If this video helped you level up your trading game, smash that like button, comment Breakout Mastery below, and subscribe to Financial Freedom FX.